Welcome to Real Estate Coaching Radio, starring award-winning real estate coaches and #1 international best-selling authors, Tim and Julie Harris. This is the #1 daily radio show for realtors looking for a no BS, authentic, real-time coaching experience. What's really working in today's market, how to generate more leads, make more money, and have more time for what you love in your life. And now your hosts, Tim and Julie Harris.
Welcome back. Today we are talking about mortgages. Mortgage Magic, 3 easy tricks to lower your rates. This is an incredibly important topic that all of you understand because obviously interest rates, they aren't going down. They're kind of leveling off where they look like they're going to be at for quite a while. So you need to understand how you can meet the buyer and maybe the seller that's moving up, becoming a buyer, how you can meet them where the market is as far as rates and what they can actually afford. So we're going to give you, I think, probably at least 3, probably more like 5 or 6 different things that you are not considering. And frankly, your loan officer might not be considering when helping that buyer afford a mortgage payment.
That's right. Now, there's going to be some technical stuff here and maybe even some math. So how do they find the notes?
We're doing math.
Warning.
Math on the podcast. Do I need to remind you that you and I were English majors?
I know, exactly.
Okay. So we're going to tell them that there's math and they're going to do it themselves is what you're saying.
There you go.
Right. So the notes for today's podcast, as well as every podcast, is available on harrisrealestatedaily.com. harrisrealestatedaily.com is our daily newsletter. You guys have been hearing about it for about a month now. I'm not sure how many have subscribed, probably over 1,000, and the feedback has been wonderful. So thank you for all of you who are subscribers. The newsletter is all of our day's notes from that day's podcast. Also the podcast link so you can listen to it. We're including videos and a lot of interviews and a lot of, I think, really unique information that's only going to be available to our harrisrealestatedaily.com newsletter subscribers. You can enroll or really subscribe by scrolling down below in the show description from today and just clicking the link, or just go to harrisrealestatedaily.com.
So how do you overcome the #1 buyer objection these days, which is this? Sounds something like this. I don't want to pay these high interest rates and high mortgage payments. I'm going to wait for the rates to come down. Well, guess what? They don't have to wait. They just have to utilize a different type of mortgage. There are several ways to overcome higher rates, and we're going to show you the top 3, which are buy downs, paying discount points, and using an adjustable rate mortgage.
Before we get into the weeds, I want you guys to think about what I'm about to say. There is a difference between financially being able to afford something and psychologically being able to afford something. So if someone's psychologically married to the idea that the rates are going to come down and they're not going to buy until the rates come down and logic doesn't prevail, then that is not a buyer. That is something you don't want to spend time with. What do I mean by logic going to prevail? I'm going to give you guys a little bit of sprinkling of some sales, essentially technique to help push the person past. They're resistant to, I'm not going to pay that much in interest. And here it simply is. And let's say that I'll make it easy on myself. Let's say the person's currently renting. Ask them, and let's say they've been renting for 5 years. Ask them if there's been a single year where their rent hasn't gone up. Ask them how much money they've paid in rent. And then show them, based on the house they want to buy, it's a $500,000 house, how much that house cost 5 years ago. And what they'll quickly learn is how they purchased the house 5 years ago, even if interest rates, and you can make them 7%, let's just say, to even make the point, because it'll still be valid, because in some markets, houses have more than doubled in the last 5 years. You could show them that not only would the house of, the mortgage payment would have easily been covered by the inflation or the appreciation on the house, making it even more plainly spoken. If you take a mortgage out, and let's say your mortgage amount is $400,000, which is about the average sale price in the country right now, average mortgage amount is probably somewhere in the mid 300s, and you actually amortize that over 30 years, figure out what the principal, interest, taxes, and insurance are in that house. You're going to find that in most cases, in most markets, the all-in payment on that house is going to be less than what the appreciation of the inflation's been on that house. As of this podcast, the appreciation on real estate in the last 12 months, month over month, year over year, has been over 7%. So that $400,000 house, and it has gone up by $30,000, and that was in the last 12 months. And that's the average. Your market might be more like 10%. And then the next question is the buyer who's saying, I'm not going to, and they have a house to sell, I'm not going to buy until I can get a lower interest rate. Well, you got to remind them that the interest rates, because of the fact that they probably have 50% or more equity in their current property, matter a hell of a lot less, but it's their ego's resistance to the idea of going from a 3% mortgage to a 7% mortgage, even though that $400,000 house that they're going to buy, they're only going to owe $200,000 on it. At 7%, that's probably the same, if not less, than they were paying on that 3% mortgage when they originally bought that house. I know that you guys got to do the math, but you're going to have to help people move past their psychological resistance to paying mortgage interest. And then you can scale it forward. 5 years from now, if things level off, and let's say the inflation per year is only 5 to 6% per year, and that $400,000 house you bought is now this, and do the math and show them how much your net worth will increase by this. Even if you were to be super analytical about it and back off the interest they paid on the mortgage, assuming there is one, they're still way far ahead than if they just stayed rented. And in many cases, way far ahead than had they just kept the house that they're presently in. You guys get it? So do the math on all these types of things. And then again, if they're still resistant, that's not a motivated person. That's a person that's got some agenda that you don't need to take the time to figure out and psychologically analyze them. Just move on to a more motivated client.
Well, usually the more motivated clients will present differently, won't they? They won't even talk about interest rates. They know what the rate's going to be. They might even be pre-approved. They're going to say, I need to move because.
Well, but that's
what they're going to be focused on. So I 100% agree with everything that you said. There are people who just simply aren't buyers or aren't buyers right now because they're more attached to what they perceive to be the right rate is than their motivation to actually move. Now, that said, I'm going to add a little sideline to this. Sometimes, because the agent themselves can't imagine paying 7%, they project their mindset onto the buyer. And maybe they're not even converting buyers. Maybe they're not even calling sign calls back or doing open houses because they themselves are wound up in this belief that's, 7%, 7.25% is the end of the world. So make sure that you, the agent or the broker, don't put your beliefs, if that's something you're attached to. Remember, people move for different reasons. Most of them have nothing to do with the interest rate.
In 1992, when Julie and I took our first mortgage out, it was 7.1%.
That's right.
And people congratulated us.
They couldn't believe we got such an amazing rate.
Now,
right.
Granted, we were 21 and 22 or 22 and 23, something like that. So maybe that was what they were more congratulating us for.
It could have been.
Yeah, but really, so if you're dealing with someone who is stuck in the mud about any of these sort of psychological issues and they're not looking at the math part of it, they don't truly have motivation. And if all your clients are like that, because some of you right now are saying, Tim just described all my clients, you don't have any clients. Those are just people that are just looky-loos. They're not real buyers. They're not real sellers. And they're taking all of your energy and all, essentially all your potential because you're not working with truly motivated people. How do you know if they're motivated or not? Use our buyer pre-qualifying script. Use our seller pre-qualifying script. Ask the tough questions before you commit any time to them. That's what professionals do.
Very well said. All right, so we're going to drill down on alternatives to the 30-year fixed. Remember that just because a buyer asks for closing costs or is getting a mortgage that's not the standard issue 30-year fixed does not automatically make them a risky buyer. This is a mistake I see listing agents making. Maybe they're just getting a lower rate, so they have some lower payments. Perhaps they're just being smart about it. Another note, credit scores are at an all-time high nationwide. Home equity, this translates for sellers who are also buyers turning their equity into their down payment. Home equity is also at an all-time high. 30, 60, and 90-day late payments are at an all-time low. This means that buyers are in a strong position to buy and are likely to just take advantage of different types of loan products versus choosing an inferior loan product, as some listing agents believe. That is their lack of exposure to different types of mortgage.
Well, it's also them being spoiled from basically dealing with very well qualified, buyers or all cash buyers.
100%. So listing agents, do your research before you shoot down a buyer just because you've never heard of their loan program or because you believe that adjustable rate mortgages are evil and have a terrible reputation. That's a hangover from the housing crash.
Of course.
Okay, now we're going to do the first one, buy downs. We're going to talk about 3 different methods to get the rate down. A buy down mortgage is one where the buyer obtains a lower interest rate for at least the first few years of the loan. There are different types of buy downs. A 2-1 buy down gives the buyer a lower rate for the first 2 years of the loan, while a 3-1 buy down gives the buyer a lower rate for the first 3 years of the loan. Easy to memorize that. The buy down fee, otherwise known as points, can be paid by the seller on behalf of the buyer, or the buyer can pay it themselves. When a buyer asks for closing costs to be paid by the seller, this is often where the money can go. Now, back to buy downs. Remember, we're separating these terms for you guys. Builders routinely utilize this type of financing, which is why closing on a new construction home is likely to have a lower interest rate and thus a lower payment. We talk to you on virtually every podcast about getting better at new construction. This is one of the reasons. Since builders subsidize lower mortgage interest rates, a buyer might have the same payment on a higher priced home using builder financing as they would on a typical 30-year fixed at the going rate on a resale home.
Okay, explain. Because what's happening is the builder is taking a dollar amount from the sale of the property, and they're actually going to the lender, and the lender is then receiving a chunk of money. Maybe it's 10 or 15 grand, maybe it's 5, does not matter. And then they're buying the interest rate down. That's exactly what's happening. And Julie was using 3-2-1 buy downs, but I was frankly seeing a lot of builders that are doing lower interest rate 30-year fixed. Yes. Or they're doing like 525s or 723s.
Well, we're going to get to all that.
Okay.
We will. And you're right. I just saw something from Toll Brothers advertising a 5.875% 30-year fixed. So how do they arrive at that? What are the points involved? You got to read the fine print, but it does exist. So let's just clarify this a little bit. A 3-2-1 buy down. In a 3-2-1 buy down, the buyer has lower payments for the first 3 years. For each of those first 3 years, the interest rate goes up by 1% annually. The full interest rate then applies beginning the 4th year of the loan. They can, however, refinance or sell the home at any time. And this is all stated in exact terms in the mortgage, so you're not guessing.
And make sure, and this is very rare, but also, a good way to razzle-dazzle your clients, make sure there are no prepayment penalties. So if you're, they're having this mortgage conversation, tell them to make sure the lender is not slipping any prepayment penalties in. What that means is if you refinance the house within the first, 1 year, 2 years, 5 years, you will sometimes literally have to pay a fee because you don't hold the loan longer. So have them ask.
Yeah, the highest one I ever saw, I think you'll remember this. We were helping a relocating executive who had moved to Columbus from Atlanta, had only owned her house for a year and was in one of these funky deals, right? And she got relocated again. I remember she called us over because she said, I can't believe I'm being relocated again. I haven't even finished unpacking. So at the time, I didn't know about such a severe penalty. She called me one day. She said, I think I'm upside down.
That's right. The prepayment penalty made her.
It was 6%.
The prepayment penalty made it upside.
That's right, because she had a smaller down payment.
Yep.
And she had done one of these loans. Now, here's the thing. We were able to negotiate that. That was kind of like an unintended short sale negotiation almost. But that's how we learned about it, is that sometimes there are these prepayment penalties. That also goes to car payments and other things. Okay, so a 2-1 buy down. In the 2-1 buy down, the discount is applied for the first 2 years, providing a 2% lower interest rate for the first year, then a 1% rate discount for the second year, and then on the third year it adjusts to the actual rate. The buyer, on their own behalf, or the seller or builder, pays the lender for the subsidy. This is paid at closing.
Now, the adjusted rate usually has a cap on it, so it's not going to go above a certain amount. But sometimes it goes to whatever the market rate is at that time.
And sometimes it's locked in. They'll either state it or they won't. So lower rates make it easier for buyers to qualify and enjoy lower payments for the first couple to few years of the loan. This makes sense, especially for buyers who expect their incomes to rise or who will add a spouse's income in the next few years. So let's do the math. Let's see how this actually pans out. Here's some examples of how to do or how a buy down mortgage can work. Say you're borrowing $250,000 with a 30-year fixed rate loan at 6 3/4. You can choose between a 2-1 buy down or a 3-2-1 buy down. The loan breakdown would look like this for a 2-1 buy down. Okay, year number 1. You are coming in at 2 points lower, a 2-1 buy down. Year 1 is at 4.75% interest and a payment of $1,300. The second year, it goes up a point to 5 3/4 interest, goes to about $1,460 in payment. And the third year, it settles into a fixed 6 3/4 interest, and that payment is $1,622. So over those 3 years, your payment has gone from $1,300 to $1,600. But you didn't walk into that $1,600 all at once. Again, this is ideal for somebody whose income is going up. Say their spouse is graduating from college and getting a job and adding their income. They know that's all going to happen, and it makes sense.
Well, but let's also look at the math there. That's a $300 difference.
Yes.
There's a high likelihood that the person will have an increase in income
Exactly.
over the next 3 years, it'll easily make it up, so the interest rate won't matter. And again, if you go back to the original, soapbox I was on, where you're getting them to look forward as far as the fact that you always have a house payment, whether you're paying somebody else's payment or you're paying your own payment, you're always going to have living expense. So you might as well buy something, even if the interest rate's not what you want, because at the end of the day, you're going to end up way far ahead. The average homeowner versus the average renter lifetime net worth, the difference is, enormous.
Staggering.
It's staggering.
That's right. Now, the buy down fee for that, the points that you would pay for what we just described, is about $5,700. Those are your points paid up front. Now, let's say you choose the 3-2-1 buy down instead of the 2-1. Here's how your loan payments would look like. The first year, again, this is going year 1 through 4. The fourth year is when it settles in. First year is $1,158. The fourth year is $1,622, just like before. But because it's a 3-2-1 buy down and not a 2-1 buy down, the fee for that increases to $11,000. So if a buyer is considering a buy down, they should look beyond the initial low payment period to determine whether the costs involved in the near term are worth any interest savings they potentially realize. So for example, if that person thinks that they're going to get relocated in the next couple of years, or maybe they're going to expand their family, maybe it doesn't make sense to have that much up front to make your payment lower.
This would be a good point to drop in the fact that even if you show up at a builder's, new build model, and you don't want to do their new construction that they've already baked in, let's say $11,324 into paying your buy down, it does not mean that they're going to reduce the price by $11,324.
No.
It just means they're not going to spend the money on your buy down because you got your own mortgage or you're paying cash.
Which is possible. That's fine. It doesn't kill the deal. It's
Yeah, what
just
I'm saying is
structure.
just because you're not using the builders have baked in buyer agent commissions. The builders have baked in, and in many cases, the mortgage stuff that we're talking about now. And with no buyer agent and no more, and if you're not using their mortgage, they're not reducing the price because the demand is there. So just keep all these things in mind.
That's right. This is why you have to educate yourself and know about a variety of these programs. Now, note to self, excuse me, not all types of loans or all types of homes can be purchased using a buy down. FHA and USDA loans have additional requirements, and you should always monitor for prepayment penalties, as Tim said. So what if a buyer wants to lock in a lower rate and not deal with all this adjustable Mickey Mouse on the buy downs? Well, that's called paying discount points up front. A buyer can choose to pay the lender up front at closing for discount points. What is a discount point? It is prepaid interest that the borrower can purchase to lower their rate on subsequent monthly payments. They are a one-time fee paid upfront during either a normal purchase or later if the borrower refinances. Each discount point costs 1% of the total amount, not the purchase price, it's the amount financed, and lowers the loan's interest rate by 1/8 to 1/4%. So it costs 8%, and it lowers the rate by between 1/8 and 1/4%. Check with individual lenders about their rules and requirements. Now, here's the thing. Discount points do not have to be paid out of the buyer's pocket, but they could be. The buyer can ask the seller to pay for discount points or the builder in a new construction purchase. Now, more often than not, though, we talked about huge amounts of equity. They probably have it to pay and have a down payment.
Exactly.
But they can certainly ask as a concession. Now, the house has to be appraised for the higher amount if they're put it on top of the purchase price. Builders, to your point, Tim, you just said that builders who subsidize loans already have it baked into the price. So you usually don't even have to negotiate on this with builders. Now, discount points make more sense if a buyer plans to keep the house for a longer period of time and less sense if they plan to sell in a shorter period of time. So think back to that 3-2-1 buy down. If you know you're going to move in 2 years, you want that lower payment for the first 2 years, and then you don't have to worry about it adjusting. You just take that and sell it, or you refinance out of it.
And remember, someone can go every year and they can just refinance into another 3-2-1 buy down and just perpetually keep that first year low interest rate. There's nothing preventing them, assuming there's no prepayment penalty.
Right.
There's nothing preventing someone from refinancing every year and just keeping their rate, I'll call it artificially low forever.
Exactly. Yeah. I mean, absolutely.
You could.
You totally could. Now, buying discount points, again, you can do that voluntarily as a buyer. You can bake it into your deal. You can get the seller to do it for you, or you can bake it into the new construction. So buying discount points can reduce the rate and lock it in for the life of the loan. This makes it superior to the buy down program in many cases. It is not the same as an adjustable rate mortgage or an ARM. We're going to talk about those next. The ARM is locked in for a limited time period. That's the difference. Adjustable means for a limited time. Commonly, those are 5, 7, or sometimes even 10 years, and then it adjusts to a variable rate. So we're going to talk about ARMs next. And again, we warned them, they can get the notes.
Yeah, exactly what I was about to say. This is, I know this is high nerd stuff, but you guys need to know this. Even if you're not learning all of it now, the important thing is to get the notes and have this at the ready when you're talking with buyers or you're talking with sellers. As promised, Julie and I are really drilling down on skills more than ever before in the podcast. Because we know that this is a skills-based market and we want you to walk into every conversation having, skills. Knowledge equals confidence, ignorance equals fear. So this interest rate conversation really does head off of a lot of other unneeded conversations that you might be having with your buyers or your sellers out there. It started out with what I originally said, Mr. Seller, or rather Mr. Renter. Do you think over the next few years your rent's going to go up or it's going to go down? Do you think the cost of a home is going to go up or it's going to go down? So would you rather be basically building equity or would you rather be building equity for the landlord of your property? So how much does the interest rate matter at the end of the day, assuming you can qualify for the payment? You guys get it?
And by the way, we did a podcast not too long ago called Why It's Still Better to Buy Than Rent. Keeping in mind that when you're renting, you have little to no control over where you'll be next year when your lease runs out. And also that's essentially 100% interest.
I'll say, though, it is not always better to buy than to rent.
I'm reading your mind. It depends on the price and the down payment and your situation.
You and I owned real estate back when we lived in Ohio.
Yeah.
That when you were 30, we bought that house in New Albany, right?
Yep.
You just turned 30 and it was a $600,000 house. And this was, that's expensive today. It was really expensive then. We were doing really well in our real estate business, the whole thing. We thought, well, we're on the right side of this, trade. We're going to do really well. We stayed in that house how many years?
5.
Okay. I added up how much money we paid in interest, PITI, well, really interest and all the rest of it, taxes, homeowners insurance, the amount of money we had to put in maintenance and upkeep. Versus what we sold it for. And we actually, if you actually penned it out and looked at total cost, we actually lost money on that house. And in a marketplace where there was appreciation, if you want to call it that, really inflation, of less than 2% on real estate, and your interest rates, as such that in your property taxes and all the rest of it, you can easily eat up your inflation or your appreciation on real estate. So back then, in many parts of the country, most of the country, you actually could make a viable argument for renting, because that same house would have cost us maybe $1,000 a month less to rent if there even was a house like that for rent, which there wasn't. But if there was, we would have been better off renting the house and sticking the money into the S&P 500 for sure.
Yes, those 5 years we lived there were not like the last 5 years you guys have lived through where people have outrageous appreciation and tons of equity.
Well, and not to mention the fact, because when Julie and I were that age, the millennials, a lot of them weren't even born yet. Okay. So there was not an enormous surge of buyer demand.
It was a buyer's market back then.
It was a huge buyer's market. So there was not a huge, demand for homes, and there was no real reason to believe there was going to be any huge demand anytime soon. And so as a result of that, that was the nature of the market. But to Julie's point, everything has changed. So going forward, in pretty much all facets, all places in the United States at the very least, you're going to be in an environment where prices are always going to go up because of demand. And by the way, did you notice that demand or other prices are still going up even though the interest rates have not fallen off? It's because of all the millennials. And that is just going to increase. Have you heard anyone making predictions that by this time in the future, there's going to be fewer millennials buying houses? Because there is no prediction like that, because no one's that dumb. Millennials are going to make, more babies, and the babies are then going to become the next wave of buyers, and there's Generation Z and all this. So it's like the most ridiculous, what do you want to call it? Christmas tree. It just keeps getting bigger and bigger and bigger. It does.
Absolutely. And they will keep making babies too.
It's called demographics, guys.
Exactly. Okay. So let's talk about adjustable rate mortgages, otherwise known as ARMs. Adjustable rate mortgages have features of both fixed and adjustable mortgages. The loan is fixed for the first 5, 7, or 10 years typically, and then the rest of the loan becomes adjustable. Remember that you can always refinance or sell the home at any time. In a 5-1 adjustable mortgage, the rate is fixed at a lower rate than a 30-year mortgage, but it's fixed for only 5 years. In a 7-1 ARM, you have a lower rate for 7 years, and then the rate adjusts. It then adjusts every year, starting the 6th year based on the performance of a benchmark rate. There are usually caps to how far it can adjust during any period. When you close on one of these, they will give you a chart which shows you the adjustment schedule. People mistakenly think that adjusting means it can do anything it feels like. That's not true. It's actually tied to something specific. Did you know that if a buyer pays discount points, they can also be tax deductible? The IRS considers discount points to be prepaid mortgage interest, which is generally tax deductible over the life of the loan. If they and the home purchase meet certain conditions, then they can be fully deductible for the year that they were paid. Little known fact there. All right, discount points can sometimes be negotiated to get more discount for less cash up front. If the borrower has especially high credit, a great job history, strong ratios, and a good down payment, they're in a great position to negotiate. It's also advantageous to shop these programs with different lenders since they do have some wiggle room, different lender overlays, and special offers. So the more of those things you have on your side, the more negotiable the lender's going to be.
We should interject in here. There's going to be qualifying mortgages versus non-qualifying, right?
Yes.
FHA, I'm getting my terms wrong.
FHA, VA, USAA, they all of them have
limit.
Different things.
Right, but the mortgage limit. So in many markets, I think the most expensive markets, you can still get an FHFA insured mortgage for up to $1 million.
Yes, and you can look that up. I think where you look that up is on HUD.gov by either your zip code or your county. Yes.
Yeah, so you can still get a government-backed mortgage up to $1 million, which is incredible. Now, if someone's doing a jumbo or a super jumbo, or I imagine there's something even over that now, super duper
Mega?
jumbo.
I don't know.
Yeah, you can. That's going to be probably a local bank or a private lender, and again, depending on the buyer's overall qualifications, assuming they're borrowing the money. Then you're going to also, negotiate directly with them. But even if this mortgage stuff, you're going to have to ultimately have a high level of knowledge about it yourself. But you're then going to have to find 3 lenders that we always suggest everyone has 3 lenders. There's ethical reasons why, but really there's more of a practical reason why. There's no way all one lender is going to be able to work equally as well with the 3 different types of buyers which you're going to run into in the marketplace. And those are your first-time buyers, your move-up type buyers, and then your luxury buyers. You want to have a lender that is comfortable working with, each of those groups. Your first-time home buyer lender is probably, in most markets, not going to be very comfortable working with your celebrity, A-list celebrity, LA, Bird Streets type, mortgage borrower,
different
right?
Guys.
You got the guy that's lending in, Tarzana is, it's not probably going to be the same guy you want lending in Beverly Hills. They're just not going to, it's just going to be too awkward for that prospective borrower. So you definitely want to focus in on having 3 sets of lenders. And the lender the lower end lender, I'd say the entry level lender, that's going to be the lender that's going to have the most versatile, frankly, skill set, but also mortgage offerings. So you're going to want to make sure that they know about all these government-backed loans. They're going to want to know about the special carve-out deals that are happening in your community because, teachers are getting special low rates and all these types of things.
I'm trying to remember if we did a podcast about all the different, I think we did for first responders, but there are so many different types of loans. We're only covering 3 on this podcast. I think a lot of agents are, they could have gone a decade and a half only doing or knowing about the 30-year fix because of rates and such. So we probably need to do a podcast about some of those different types of loans.
Well, I'd take your notes from today's podcast and I would call up, Larry, the probably lazy lender, and I would quiz him on what his knowledge was.
Well, that's going to be their homework. So
yeah, okay. I don't
more foreshadowing. That's okay.
Sorry.
Well, and you make a good point about not all lenders are the same. It's not just it is mainly the different types of borrowers, but different lenders have different programs too.
And even if the lender says, oh yeah, we do FHA mortgages, and maybe they do.
How frequently?
It doesn't mean he knows anything about them. I mean, he could, maybe he just doesn't, he's never done one before. It's not very, you guys get it? So you're really going to have to be careful because the lender can easily screw up a deal.
Yes, that's right. Now, lenders do like to receive discount point money because it's cash up front.
More commission for them.
That's right, versus receiving it over time via the interest rate. This may seem like an unusual conversation given the years and years and years of 3.5% mortgages, but it is actually quite common practice. You just have to know about it. Remember that knowledge equals confidence and ignorance equals fear. So your homework that Tim just gave you some foreshadowing on, sit down with at least 2 or 3 loan originators, ask them how their buy downs, discount points, and adjustable rate mortgages work. You don't have to know everything about this. Just be fluent in what's available to your buyers. And I wouldn't even limit it to that. Ask them what other special programs they have. There's some first-time buyer grant money out there that's dependent on the type of property, the zip code, whether you're in an urban environment, maybe different zones. So ask them about their special programs. I know you and I did several for doctors that were different because Doctors could have really terrible ratios because they're student loans, but the lenders considered them a good risk. And if they had good credit and otherwise didn't have a bunch of debt other than their student loans, they'd get advantageous pricing.
That deal's still around, but I'm trying to remember. I think that was an FHA deal.
I think it was too.
It was.
I think they had to be first-time buyers.
They had to be first-time buyers. They had to have decent credit. It doesn't matter what their student loan debt was.
Yeah.
And they had to put hardly any money down, and they
That's right. They had smaller down payments.
Yep.
It's kind of like the student loan debt was not given the same weight in their ratios as it would nor other types of debt.
Well, it's because the lenders, knew that they were low risk because
going to be high income.
Well, hypothetically, but
yeah. So make sure you're finding out who's doing what kinds of loans. This is how you overcome that objection. I don't want to pay such high rates. I'm out of the market for a while. By educating your buyers about options, you may re-motivate them to get in the saddle. And remember, too, really what they're objecting probably is the payment, not the interest rate. So all three things that we talked about today, get the payment down. Are you more interested about, what the percent is, or aren't you really asking about what you can get your payment down to?
And are they objecting to the payment and the interest rate for psychological reasons or because they literally can't afford it?
Two different things, right?
Right. If they literally can't afford it and there's no chance that they're going to be able to afford it, get a different job, earn more money, or whatever, reduce debt, then that is not somebody you should be spending time with because they are not emotionally and even financially qualified. But if you're dealing with someone that's psychologically a little bit unhinged and that's their reason, I want lower rates, I can't imagine paying these prices, all this type of stuff, I promise you those people will drive you wackadoo because they're never going to transact. Ask them some clarifying questions. Julie and I gave you a lot of those today with regards to the trajectory of the market. And you'll find these type of wackadoo folks, they'll say, there's going to be a real estate crash. Prices are going to fall. There's going to be a blah, 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 blah. In other words, they're just, they're not orbiting.
They're not buying anything.
They're not buying anything ever. They're orbiting a different universe that you don't ever want to know about. Okay. It's, Battlestar Galactica meets
which
real
isn't
estate.
for sale.
Which is
okay.
exactly.
Now, so the other thing that I was thinking about this is where you do hear about clients utilizing these programs isn't the crazy patch where they're, looking for both housing prices to fall and rates to fall. And oh my gosh, I would never do this or that. It's smart people who are just utilizing these as a tool. They have plenty of money down. They just find out from these programs from their agent, again, articulating your value for the buyer side, like you all have to be learning and relearning how to do, considering what we're going through on the buyer side. It's smart clients that probably could easily do a 30-year fixed at the higher rate. They just don't want to if they can do one of these programs and save some money.
And again, to Julie's point, you're now trying to win the business of buyers, just like prospective listing agents that compete for a listing. You're going to have to go through a very similar process. We're teaching our coaching clients how to do that now. Coaching clients are, our exclusive clients have the version of a pre-listing pack, but for buyers, they're going to have buyer presentations, everything. Those things have been in place as part of Premier Coaching for decades. We're always improving them, and we're going through a big upgrade cycle now because of the commission sharing lawsuits. Well, this obviously is going to be part of it because you're going to have to show your buyer why you're worth them paying. If they're going to have to obligate themselves to pay your buyer agent commission, and they're not going to do it unless you can prove to them that the value is there and you're worth them paying for it. And that is part and parcel of the knowledge equals confidence and ignorance equals fear. So if you're fearful about the mortgage interest share, the commission sharing lawsuits and the buyer agent commissions no longer being an entitlement to a real estate transaction, you don't just automatically get it. It's because you are internally fearful that you cannot prove your value to that prospective buyer. And if that is what's going on in your head, there's time for you to fix that, but you're going to have to earn it. It's not just something you're going to walk into. FOMO is still going to sell houses, fear of missing out, but FOMO is not going to get you paid on the buyer agent side of the transaction. You have to earn it.
Very well said. So you guys know what you need to do for homework. And when in doubt, don't go into the real estate wilds alone. Sign up for Premier Coaching. You can do it for free so that we can help you.
You guys have a fantastic day. We'll talk with you on the show tomorrow.
This podcast is a part of the C-Suite Radio Network. For more top business podcasts, visit c-suiteradio.com.